Okay, we're at session 16, as you saw. We're going to start on a new topic, but before we do, I misspoke yesterday that we're going to have the exam on Wednesday, but Wednesday happens to be July 10th, not July 9th, as our trusty TA, Shawnhook, just informed me. So it'll be on July 10th. Now, we're going to go into a new subject now, and it's a very interesting subject. And let's see where we are. It's derivatives. This has nothing to do with the mathematical concept of a derivative. Okay. We'll say a derivative or a derivative security, it's sometimes called, T. We'll say a derivative's value is based upon or derives from, is where we get the derivative, some underlying asset. Now that asset can be a physical asset, such as a bushel of corn or bushel of soybeans that you see in the commodities market, or it could be an ounce of gold, or it can be a financial asset. It could be, we can have derivatives based on the Dow Jones Industrial Average. But the main thing is that the derivative takes its value from something else. Now, why use derivatives? Recently, derivatives have gotten a bad rep. They say a lot of the previous financial meltdown was due to derivatives. Well, it's not really due to derivatives, it's due to people misunderstanding the derivatives. Derivatives, we use derivatives to manage risk. They're also used to hedge against future price movements. So with derivative instruments, we can manage our risk, and we'll show you some neat strategies with derivatives. Now, the two most common derivatives are the futures and forwards, or the options. First is the futures and Huenberger starts out on futures with forwards, and forwards are not used anymore. And options. we'll also talk about swaps. Here. But futures and options are the most common form of derivatives. Now in this area of derivatives, there's a lot of definitions that you have to know. The area is pretty simple, but you have to get used to these definitions. So try to follow these definitions along. They have a whole vocabulary of their own. Okay, what is a future? Let's define a forward. First, we'll put future in parentheses here, because now we don't use forwards any longer. Is an obligation to buy this is the long position, or sell a specific amount of an asset at a specific date and specified price. Okay, so we said that asset can be, the sell is a short position. That asset can be a commodity or it could be a financial asset. Okay, and where these forwards came about was by farmers. If you can think of this. The origin is the farmers. In fact, there were futures back even in Greek times. They trace them back to. The idea is the following: the farmer needs, in the spring, needs money for fertilizer and seeds, and he also has to have fuel for his equipment to plant. And the farmer sells his crop, doesn't get money and sell his crop until the fall. So if the farmer can sell a future on his crop, then he can go to the bank and the bank can lend him money based on this contract here. Now, the bad thing, the downfall of the forwards is the following. We have a negative aspect of forwards, that both buyers and sellers must trust the other parties. Somehow they must check out these other parties and make sure, if you're a seller, you want to make sure that when you have your crop there, that the buyer doesn't say, well, I don't have any money right now. I can't buy your crop. So you have all this crop here. And if you're the buyer, you want to make sure that you get your the amount of commodity that you ask for. Okay. So now, instead of forwards, let's write that out a little better. I can't even read that. Okay. Now instead of forwards, we use futures. To overcome this problem, the futures market was developed. The futures market has a bunch of advantages. Okay. It's standardized amounts. Like you can only buy corn in 50,000 bushels worth. So multiples of 50,000. So we have standardized amount. In the forward, you could specify any amount you want. Okay. Also, we don't have to worry about a buyer or seller defaulting. Okay. And the way we do this is by the following, by an ingenious development called marking to market. Now, you might have heard about marking to market in the financial crisis, because they ask a lot of firms to mark their assets to market. But the real origin of marking to market is in this futures contract. Okay. Marking to market. Okay, so what is this marking to market? It says the following. At the end of every trading day, all futures accounts are marked to market. What this means is if the value of the commodity in other words, the current spot price goes up, your margin account which is typically 2 to 10% of your position is, when we say has, an amount added to it. Okay. Because you bought it at a certain price, and now the spot price is higher. So when you go to sell it, you'll get that higher price. So of course, you should be that. And in the futures market, you have to put up a margin account, a small margin account. Now you can, when we talk about margin accounts, and we'll talk about them and other things, actually even in shorting, the margin accounts can be in cash, like dollars or euros, or they can be in so-called near cash assets. Near cash assets would be a treasury note. So you can put in your margin account something that is still earning some, although nowadays the interest rate is so small, the federal funds target rate is near zero, that you're not going to earn a whole lot. Okay. Now, if however, the spot price goes down, oh, this, as it goes up, this should be, of course, this is the long position. Now the spot price goes down, an amount is subtracted from the long positions. Long position margins accounts. Okay. Now, we also have to protect the broker. If your margin account falls below a preset limit, your account is wiped out by entering an equal and opposite trade, and the remainder, the dollars in the account, are returned to you. there's a great movie, which probably you've seen. It's a little while ago. It's Eddie Murphy, and it's called Trading Places. If you haven't seen this movie, you should get it on Netflix or whatever service you use. Trading Places is great. Here you can see what happens with margin accounts. They're talking about the orange juice crops. Okay, now, so what happens is the brokers can never lose money. So this marking to market is ingenious. It just lets all the trades be thing. On any long trade, there must be an equal and opposite short trade. Okay, let's do some other things today. Okay. Oh. Yeah, let's talk about the forward price formula. You might think of this as the future price formula. I don't know why Leuenberger spends so much time on forwards. Most text will just go right to futures because that's what we'll use today. Okay. Now, what we're going to do is we're going to suppose that we buy by 1 unit at spot price equals S at time 0. Okay, so we buy 1 unit of an asset at time 0. Okay. And enter into a forwards account, a forwards contract, to deliver it at time t, capital T here. Okay, so we buy a unit at spot price S at time 0. We could have called that S0 if we liked. And enter into a forwards contract to deliver it at time t. Okay. At price F. Okay. So now what do we have? We have the following. We have that S, the present value at time 0 is what? Equals D0T times F. Okay. Now, what is this D0T here? This is our discount factor. Okay, because what do we know? We know that an amount in the future is worth less in the present, right? That's the opposite of the idea, is that if you put money in a bank, it grows your account. And that discount factor equals what? Equals 1 over 1 plus I, whatever the rate is here, to the t. We'll assume that t is a integer, okay? Since we have what? The future value of an amount s after t is what? Equals 1 plus I to the t times s here. I think that the Bloomberg doesn't define the discount factor there, he defines it earlier. Somebody had asked about reading chapters 1 to 5. I really don't think it's necessary to read chapters 1 to 5 for the course. And this week we're also going to talk about the test in a little bit. Okay. So now let's look at the forward price formula. And the forward price formula is as follows. Suppose an asset can be stored at zero cost. Suppose our asset can be stored at zero cost. And this is not at zero cost because you know they have all these grain elevators here, especially if you live in Indiana, and sold short. And suppose that the current spot price and this could be per unit at t equals 0 is S. Okay. The theoretical forward price price F at t equal t, big T, is F equals S over D 0 T. Okay? Okay, because now we think of this as that we put S dollars in the bank at time 0. This is analogous to putting S dollars in the bank at time 0 and let's not worry about the interest rate here. So it's analogous to putting S dollars in a bank at time 0. That will grow there. Because this d of 0t, remember, is 1 over 1 plus t, right? So this equals what? This equals S times 1 plus I to the t here. And this is, I think it would be better if he wrote that equation that way. This is equation 10.1. 10.1, page 267. Okay. Okay, now, suppose that we take into account the cost of carry. The cost of carry. And we'll say that is CK equals CK in period K. Okay, and that cost of carry, you can think of that as our inventory cost. So it could be the cost of the unit inventory cost of putting corn in a silo here. Okay. Okay. And let's look at the forward price formula. With carrying cost. Or inventory costs. Okay. And here we have this is the following. Suppose our asset can be sold short. The reason we have these sold short assumptions here is you'll see if you look at Leuenberger's proofs, he tries to create synthetic portfolios here. And the initial spot price is S. Spot price is S. S. Okay. And the carrying cost, as we just said, equals CK per unit. All these costs are per unit, and period K. Okay. Then the theoretical future price F is as follows, is F equals that spot price, and we move that forward, D0M, so we're over this discount factor here. So that moves forward. That's the current value or the future value of F of S at time M or time T, plus what? Plus we have to take the future value of the different holding cost, okay, equals 0 to M minus 1. Remember we said that T equals M here over, now we take a discount factor K from K to M. And this is equation 10.2, page 269. So it's easy to include the cost of carry in this. Now, let's look at some other things here. Okay, let's look at the value of a forward or futures contract Okay. Now we'll say suppose that a forward, whenever Leuenberger says forward, just replace that with future. Contract for delivery at time t. Capital T, we always have that delivery time, capital T, in the future. Has delivery price F0 and a current forward price, that's the price of the forward contract, at time t of ft, f sub t. Okay. Then the value of the contract is of that contract is as follows, is ft, little ft, equals ft minus f0, We take the difference here between the current forward price and the delivery price, F0, and we discount that back from time t to time capital T here. Okay. So actually, we're discounting that forward now. Okay. Okay. Let's see what else we have on futures. Okay. Here's something important. It's the futures forwards equivalents. Okay. This says that under reasonable assumptions, the theoretical forwards and futures prices are identical, which should be obvious. All the futures did for this was to put it in a marketplace. Okay. Okay. Now, let's go over the futures market. Recall that in marking to market, futures accounts we have the following. One, if we are long, by long we're buyers, then and the future price goes up, then dollars are added to our account. To our margin account. Because now a future contract is worth more, because if it's going up, it's worth more if we're buying. Here. If we are short, in other words, if we're selling, the seller and the price goes up, then dollars are subtracted from our margin account. And if we fall below a reserve margin, then our account is wiped out. Now, the easy way to remember this is that if you're short, or the seller, two S's there, then the dollars are subtracted here. Okay. Because we're going to be doing a number of combinations of things, so we'll have to know exactly what this vocabulary here. Oh, let's get this here. Let's see. Okay. Let's talk about hedging. Okay. We'll say the primary use of futures contracts is to hedge and really when we hedge we want to avoid risk against future price movements. Okay. And we can have two types of hedges. We could have a hedge called a perfect hedge. That doesn't mean that it avoids all risk. Okay, a perfect hedge and a long perfect hedge, we can think of this as buying the futures purchases immediately. So if we buy the asset immediately, we lock in the price. We don't have to worry about later, but we might have to do it. What we might have to do is this accounts for some money here. Okay. Now, one thing in forwards and futures we have to remember no money changes hands except, for, of course, for the margin account until delivery. And in fact, what happens in the real world, most of these accounts are not delivered. Nobody's delivering, because if you're buying, say you're buying 500,000 bushels of corn, you don't want in 3 months to have 5,000 bushels of corn dumped on your driveway or your lawn. So typically, these are just pieces of paper that are played with. But maybe about 10–15% are actually delivered here. Because we have things with futures, like in energy things, we have there's a lot of natural gas futures contracts. So there's a lot of hedging on natural gas here. Okay, why don't we stop there now? And then we're going to go on with this. This is a very interesting area, and we'll find out some very interesting strategies that you can use and companies can use to manage risk. So this is a really exciting area. Okay, we're a little bit early today, but that's okay. You get out early today. Okay, and remember that that's July 10th, not July 9th. Okay? Sorry about that.